Now, it's understandable why investors love ETFs. You get low costing, total market exposure, and an overall simplified investing experience. Even Grandmaster Warren Buffett has said that most people are just better off buying a total market fund for an all-round cheaper, more efficient way to grow your own money. But those who preach this message are not giving you the full picture, because there is a much better option. And with just one small change, the average American can boost their investment at retirement by a staggering $2 million. Yes, $2 million. And the best part of all, it requires hardly any extra work, and you can even still use Vanguard or your favorite ETF provider. To show you what I mean, let's say we have $100,000 and we've been tasked to build a car for a plus 3,000 mile road trip across America. We need to build a car to get us from coast to coast in the fastest time possible. We then look at a list of all the potential customizations, and there are thousands upon thousands of options. We can pick how big the engine's gonna be. Are we gonna have heated seats, underglow neon lights, and we can even customize the bloody seatbelt. The big question is, how would you spend this $100,000 to get to your destination as fast as possible? If we buy the biggest engine possible, we may get there faster, but we're gonna have to fill up fuel quite a lot of times, which will also cost a lot of money. The best gearbox and transmission may break down as we push the car to its limits, delaying our journey even further. Vanguard or Schwab's simple answer to this problem would just be to buy every single thing on this list, even red latex seatbelts. And that is where the problem lies, because the reality is, in our 3,000 mile journey, we don't need everything on this list. We just need an efficient engine, a seat, and a steering wheel. We need to get going as fast as possible in a safe manner without taking any extra risk, while maintaining the fastest speed possible. And your financial journey is exactly the same as this example. The reality is, you do not need all the companies within the S&P 500 to gain your wealth. Everybody has been told you need the whole market to get diversification. But coming back to Warren Buffett and Berkshire Hathaway, about 80% of their portfolio is in just 5 big names. And I understand why. And that is because Warren Buffett sees this not being an issue, because not only do these businesses have a moat, but inside themselves there is a lot of diversification to justify such a large position. For example, Apple, which is his biggest position by a long way, is not just an iPhone provider. They have an app store, telecommunication services, they have data, they have different versions of retail technology. You name it, Apple is in it. And they're even rumored to be making a car, which I hope is less than $100,000. Now, diversification for a lot of investors is true. We're not all Warren Buffett, but it is still overhyped. You don't need all 500 companies. Many people just say go and buy Vanguard's total market ETF, like ticker symbol VOO, because it has the lowest cost and has the same exposure as the rest of them, which ultimately means you as an investor get to keep more of your returns because of them lower fees. And it will work for you. You will still do well doing this strategy. But the issue is, these returns are limited by red latex seatbelts. If we look at the past 10 years or so, we can see that there are some standout sectors that just do not perform as well as others. To show you what I mean, I want to compare different Vanguard funds. So we're comparing apples to apples and teams to teams. If we look at Vanguard's energy sector ETF, which is ticker VDE, we see that over the past 10 years, it's actually not been too great for us investors, even with their big dividends. Over the past 10 years, this sector has offered you a pitiful 3.2% annualized returns. That's not enough to even beat inflation, and way below the market average return in this same time period. And this is the problem, because if you bought the Vanguard VOO, which is the total 500 companies in the S&P, you are buying this massive underperformer, and it's going to drag down your returns. And it's not just the energy sector. If we look at Vanguard's real estate ETF, ticker VNQ, this sector you would think would be flying. The past few years, housing prices have gone through the roof, but it's not doing too well. In fact, it's only offering you 6.35 annualized returns in the same 10-year period. Again, way less than the VU benchmark of 500 companies giving you 12.5%. And this real estate ETF is long after the 2008 crash, so there's not really any logical explanation. Now, some will argue that's because these sectors are cyclical in nature, and some will say that you should still have exposure to them no matter what. And fair enough if that is your strategy, but my question is, why would you settle for less returns? Why would you buy red latex seatbelts knowing that in a lot of time frames it's an underperformer? The point is, you can pick standout sectors that are just performing better than the overall market. Sectors which are just better at managing cash, offer better returns, and the big one, actually do better in a recession. And taking this approach by picking which sectors you should be investing not only increases your returns drastically, it actually doesn't take too much research. To hammer my point home, if we look at the same 10-year test and we look at just the top 4 performing sectors and allocate 25% of our investment to each of these sectors, our returns go wild compared to the overall market. The 4 sectors are the information technology, consumer discretionary, healthcare, and would you believe it, financials. Vanguard's S&P 500 flagship, ticker symbol VOO, over 10 years has averaged 12.57%. Whereas in the same test, these 4 sections, if you did what I've just told you, would have averaged 14.08%. Now that might not seem like a big difference, especially given Vanguard's VOO is a little bit cheaper. But if we compound this return, well, it's literally staggering. The average 30-year-old in the US is earning about $50,000. And we know from people like Dave Ramsey, you should be investing at least 20% of this figure, which is $10,000 a year or $833 a month. If you pick this VOO option on its 10-year average of 12.57% for the next 35 years from age 30, you would have just shy of $5 million at 65, which, don't get me wrong, is brilliant, not bad at all. But if you were just a little bit more selective, and again, the averages continue, this 14.08% from these 4 sections will rocket your $5 million to $7,150,000 US. Every small little increase in return you can generate every single year will compound on itself and ultimately affect how much money you have in retirement and even how early you can retire. With minimal research, you can actually beat the market. The lie that you cannot beat the overall stock market is something that has been built into society for those who are picking stocks. We now have sectored ETFs that will offer you better returns with minimal research. So why would you buy the overall market? And what's more is this 7 million potential return with these 4 sectors can turn into over 10 million without doing anything at all. So find out how to max out your wealth with this free money in this video here.